All right, let's dive right into this explainer. Today, we're taking a system that we all have to interact with and turning it into a clear, mechanical masterclass. We're going to look closely at how your financial health is actually graded in the United States. Because whether you're applying for a mortgage, financing a car, renting an apartment, or even just trying to get a premium credit card, very few numbers have a greater impact on your life than your credit score. So grab a notebook and let's explore exactly how this system works together.
Think of your credit report as your financial report card. I absolutely love this analogy from our source material because it perfectly illustrates how lenders view you. When a bank or a landlord looks at your application, they don't know you personally, they are essentially looking at your past behavior to predict your future reliability. They're checking your report card to see if you're the kind of student who turns their assignments in on time, or if you're someone who constantly misses deadlines.
So here's our syllabus for today. 1. Your financial report card. 2. The grading rubric. 3. Myths and costly mistakes. 4. Defending against fraud. And finally, 5. Rebuilding your score. Let's kick things off with Section 1, your financial report card. Basically, your credit report is this detailed running record of your borrowing and repayment history. It tallies up everything, from your credit cards and student loans to your mortgages and auto loans. It tracks your account balances, your payment history, how many times you've asked for new credit, and even public records related to debt. Now, because not every lender reports to every single bureau, like Experian, Equifax, or TransUnion, the information at one might look slightly different than another. But overall, it acts as the master record of your financial behavior.
Now, the real-world cost of this report card is honestly pretty staggering. Take John and Lisa, for example. Both are buying the exact same $350,000 house, but John has a 780 credit score, while Lisa has a 620. Because John presents a lower risk to the bank, he gets a much lower interest rate. Over a standard 30-year mortgage, that difference in creditworthiness, not their income, not the property value, literally just their credit history, will end up costing Lisa tens of thousands of dollars more in interest.
So the crucial takeaway here is that your credit score is really just the final numerical grade summarizing that long report card. The most common scoring models in the US range from 300, which is considered poor, all the way up to an exceptional 850. This three-digit number tells lenders at a single glance exactly how risky it is to lend you money. The higher your score, the lower your perceived risk, which is what unlocks those lower interest rates and better loan approvals.
Moving right along to Section 2, the grading rubric. Lenders essentially look at 5 primary factors to grade you. And the biggest chunk, 35% of your score, is based entirely on your payment history. Simply put, do you pay your bills on time? Even one single late payment can seriously hurt your score. The next biggest factor at 30% is your credit utilization. The remaining 35% is split between the length of your credit history, meaning older accounts are better, at 15%, and then a 10% slice for the mix of different types of credit you have, and another 10% for how many new credit applications you've recently made.
Let's focus on that second largest factor for a second, credit utilization. If there's one golden rule to write down in your notes today, it's this number, 30%. Credit utilization just measures how much of your available credit you are currently using, right? So if you have a $10,000 limit and a $2,000 balance, your utilization is 20%. Financial experts strongly recommend keeping your credit card balances below 30% of your total limit. Pushing past this signals financial stress to lenders, and it will pull your grade down even if you make all your payments on time. Ideally, keep it below 10% for the absolute best results.
All right, on to Section 3, myths and costly mistakes.
I hear this question constantly from people who are absolutely terrified to look at their own financial standing. They really believe that the mere act of checking their score will somehow lower it.
The truth? That is completely false. Looking at your own score is what's called a soft inquiry. It does not affect your score at all. Zero impact. In fact, reviewing your credit reports and scores several times a year is a highly recommended financial habit. It's the only way you can actually track your progress and catch errors before they become huge problems.
How about this one? Here is another incredibly common misconception. The idea that you have to stay in debt and carry a balance from month to month just to prove to the bank that you can handle it.
Let's debunk this one right now. Absolutely false. You do not need to carry debt to build credit. Paying your balance in full every single month demonstrates incredibly responsible credit management. Plus, paying it in full saves you from paying entirely unnecessary interest charges. Please, do not pay a bank extra money just because of a myth.
Okay, let's say you finally pay off a credit card that's been stressing you out for years. Your first instinct might be to chop it up and close the account forever, just to be safe. But is that actually a good idea for your score?
Well, not necessarily. Remember that utilization ratio we just talked about, the 30% rule? Closing an old card actually wipes out that card's credit limit from your total available credit. So if your available credit drops, any balances you still have on other cards suddenly take up a much larger percentage of your overall limit. This spikes your utilization ratio and can immediately lower your overall grade. Plus, closing old accounts reduces the average age of your credit history. So unless the card has some massive annual fee, keeping long-established accounts open is usually going to benefit your profile.
Let's switch gears to Section 4, defending against fraud.
Because let's be real, credit reports are not always accurate. They could have outdated info or mixed up personal details, and worse, criminals might use your stolen information to open cards in your name. You literally must review your reports regularly in the digital age. Look out for warning signs like unexpected inquiries, accounts you never opened, collection notices for debts you just don't recognize, or a sudden unexplained drop in your score. Spotting these red flags early and disputing inaccurate information is really the only way to prevent long-term damage to your financial report card.
And finally, Section 5, rebuilding your score.
The good news? A bad grade is never permanent. Take Maria, a 34-year-old teacher in Arizona from our source material. After some unexpected medical expenses and a temporary job loss, she missed several payments. Her score dropped from a solid 730 all the way down to a 610. But Maria didn't give up. She treated her credit like a class she needed to pass and executed this exact structured recovery plan. First, she set up reminders and paid every single bill on time. Second, she aggressively reduced her credit card balances to fix that utilization ratio. Third, she stopped applying for new credit entirely. Fourth, she made a strict monthly budget. And fifth, she built an emergency savings fund so she wouldn't have to rely on credit for future surprises.
This timeline perfectly illustrates the power of patience and consistent habits. In just 2 years, her discipline completely repaired the damage. Her score went from a 610 all the way up to a 750. And because of this, she later qualified for a lower interest auto loan and purchased her first home with favorable mortgage terms. It didn't happen overnight, but she did it.
However, a quick word of warning. Please avoid anyone offering extra credit shortcuts. As you saw with Maria, legitimate improvement takes time. You should always beware of credit repair scams. No legitimate company can legally remove accurate negative information from your report just because you pay them. Watch out for promises of instant score increases, guarantees to wipe away your history, requests for large upfront fees, or any advice telling you to lie on a credit application. Strong credit is built over years, not weeks.
The ultimate takeaway from today's lesson is simple. Good credit is not reserved for the wealthy. It actually has nothing to do with your income. Your financial future isn't defined by your past mistakes, but rather by the proactive, consistent habits you choose to practice starting today. Paying bills on time, keeping debt under control, and monitoring your reports, these are the actual habits that build wealth and unlock opportunities.
So, I want to leave you with a final exam question for the day. What does your financial report card look like today, and what is one step you can take right now to improve it? I challenge you to pull your own report this week. Check your grades, look for errors, and take complete control of your financial destiny. You have the rubric now. Class dismissed.